Hello and welcome to BQ Prime. I'm Muralidhar Swaminathan. I have with me a very experienced international markets expert, Krishna Memani, who has managed billions of dollars when he was heading Invesco and earlier Oppenheimer. Now he's managing a college fund, which is an endowment fund, I suppose. And he's going to tell us how to navigate this perhaps one of the most turbulent times that the markets are witnessing ever since the Lehman Brothers crisis. And let me go straight and welcome to the show, Krishna Memani.
My pleasure. Thank you. Thanks for having me.
So my first question is, we are in turbulent times, and what should we worry about, or who should we fear? Should we fear Credit Suisse or should we fear the Fed?
So that's an interesting question. I think my first response would be what not to fear. That is that this is not a global financial crisis. 2008, 2009 period, people who were around, I think it was a very traumatic period. And while we have issues, they are not at the same scale and of the same magnitude as it was the case in 2008 and 2009. The situation in the U.S. in particular, and Credit Suisse is a separate, it's a corollary rather than the main symptom here. The situation in the U.S. has been primarily driven by very rapid increase in Fed's policy rates from 0% to almost 5% over a very short period of time. And previous to that, we had a very expansive fiscal policy that created lots of bank deposits in the system. And banks took those deposits on, thinking that they will be there for a long period of time, invested them in really long bonds at very low rates. And when the Fed raised rates, those bonds are underwater. So that at the core is really the challenge we are facing. The fact is, inflation in the US and perhaps globally is much higher than what the central banks would like. And they have been tightening policy. And once things settle down, they will probably go on tightening policy for some time.
Right. So you said that policy rates have gone up, but most of the banks have locked their funds with low rates and therefore leading to a loss, which typically happened with the Silicon Valley Bank. Are there other banks also in the same bracket? Are they facing those kind of crises?
Oh, yes. I mean, the entire regional and community banking system in the US is built off of really cheap deposits that they get from people who use those banks for transaction purposes. And so, yes, there are, if you look at losses or book losses on held to maturity portfolios of basically any significant bank, that is going to be very substantial and can account for perhaps a quarter, if not half, of their tangible equity. So it's a real issue for the banking system. Having said that, I think this is to be expected. The problem with Silicon Valley Bank was their deposits were very flighty. That is, their deposits were held by VCs and they started pulling those deposits. That's probably not the case with most other regional banks. And therefore, it's a trying period, but we'll come out of it. We have had these situations before.
Right. So, two different issues here. One is the SVB triggered kind of situation, if I may say so. And the other is the Credit Suisse. And the third overarching problem is the Fed itself, hiking rates. Mm-hmm. Now, among the three, suddenly we find there is some sort of brotherhood, who people have come together and put in some $30 billion and say that, look, let us all save ourselves. I will help you, you help me. We have put in $30 billion and saved First Republic. That's something unheard of, I suppose. How do you look at it?
Well, so it isn't entirely unheard of. If you remember, in 1998, the banks came together to bail out LTCM, which was a hedge fund that was upside down in terms of their hedging and liquidity. So this is not unheard of. But I think what the Fed is trying to do is, in addition to provide liquidity to the banks, do a little bit of confidence building by showing that the banking community is behind a lot of these smaller institutions where the flight risk is quite substantial. So it is probably a prudent move. Whether it'll work in reality or not is an open question at the moment.
Right, but you're not sure whether it will work, or maybe the funds are not enough.
Yeah, well, the funds are not enough. I mean, this is putting in $30 billion in a $200 billion balance sheet financial institution, which has all sorts of issues, because its clients are really high net worth individuals who left a lot of deposits on their balance sheet and probably are going to pull out. So this money will basically go towards funding that deposit flight rather than change the basic equation for the balance sheet and the income statement of that particular financial institution.
Okay, before I switch to Credit Suisse, I have two more questions. One is, in your estimate, how many regional banks are facing some such situation? Is it a large number, or have you narrowed down to number of banks and a quantum that you can put to?
Well, so I think the impact of higher rates on bank profitability is going to be with us for a long period of time. What is not going to be with us for a long period of time is deposit flight. And with the availability of funding from the Fed on their discount window and their new bank facility that they have provided, where they are going to take in the safe assets at par, I think the deposit flight issue probably gets addressed relatively quickly. Having said that, the challenge with respect to the Fed tightening and the impact on the economy and bank balance sheets, that is going to be with us for a long period of time until the Fed eases eventually.
Yeah, which we will come to know next week, I guess. Yeah. Now, so before I go to the Fed question, let me now shift focus to Credit Suisse. It's a little strange. They claim that they have enough capital. They have a great CET ratio of some 14% and coverage ratio of about 150%. And they are saying that I am bringing down the cost this year by $1.5 billion, next year by another $2.5 billion. But still, it's being hammered. People are panicking. So what is the root cause? And see, this $54 billion that support that they are getting from the Swiss central bank has arrested some fears to some extent. What is your assessment of Credit Suisse? What is the core problem? How do you look at it?
So as a Credit Suisse alumnus, it's a very sad state of affairs. I was there 20 years, almost 17, 18 years ago, and it was a very different institution. The problem with Credit Suisse of late really has been lack of profitability and risk management in its core business, both at the investment bank and at the wealth management. So the investment, they have had a restructuring process for a long period of time. This probably was the tail end of that restructuring process. I think one thing that is driving all of this is the fact that people don't have a great deal of confidence whether that restructuring will actually work or not. So that's really the core issue. Having said that, when you face these types of financial pressures, the markets have a tendency of gravitating towards taking or meting out a lot of punishment to the weakest of the herd. And Credit Suisse of large GSIBs in the world is probably the weakest one because of the core problem in its franchise and to some extent its funding situation, which was basically customer deposits. They had faced close to $100 billion worth of outflows in Asia in the fourth quarter. They managed that very well. I think the difference between Silicon Valley Bank or any other bank in the US and Credit Suisse is they don't really have a big mismatch. That is, their liabilities are short and their assets are relatively short as well. So it's far more matched. And I think with a little bit of support from the Swiss National Bank, I think they can skate through this particular challenge. Whether they will be successful in restructuring their business, again, is an open question at the moment.
Right. So the same question came up last time. I think the October board meeting, they set out a very clear restructuring plan and said that by 2025 we will be able to come out of the thing. Once again, the crisis has hit them.
Mhm.
The question is this support of $54 billion enough? That's part one. And how long will the central bank keep bailing them out? Now, where are we headed towards this?
So, the near-term liquidity situation can be very easily addressed by $54 billion worth of support. And if needed, SNB will probably provide them more support because they have liquid collateral that they can provide against that. Having said that, I think one could probably argue that Credit Suisse is a bit of a broken firm. That is, they have had perennial problems in all parts of their business. And when you face these types of liquidity issues in a crisis, coming out of it with your client relationships and your entire reputation fully intact typically does not happen. So I would expect them to be restructured in some way, not a resolution, but perhaps they have really good businesses. Their investment bank was in the process of being spun out. Their structured product group was acquired by Apollo. I'm sure there are lots of banks in Europe who would be very interested in their private wealth management. So I think something along those lines is probably the most likely outcome. If they come out of it together and prosper, nobody would be happier than me, but I don't think that's very likely.
But do you think UBS would like to merge it with themselves, or that's something which is not a plausible?
I think UBS in people's mind is probably the ideal acquirer. Somehow, I don't think that is probably going to be the final outcome. I think final outcome probably will be some other large European financial institution who's far more interested in wealth management, because wealth management contributes a lot of stability to the income statement of a bank. And as Morgan Stanley has shown, if you have a really good wealth management business, the firm can shine. So this is a good asset, and I think it'll fit probably better with somebody else rather than UBS. But SNB may have totally different thoughts on this.
Right. Okay. So let me now shift focus to, let me try and add up all the bailout amounts that have come out. Roughly it could run into billions of dollars. Possibly it could add up to what the Fed would have done if they had done quantitative easing.
So the funding, as it came out last night, is north of $300 billion based on the money that they have given to the FDIC to support the bridge banks at Silicon Valley and Signature, and the facilities at the discount window and the new bank financing program. Having said that, I think this is not QE. That is, every expansion of a central bank's balance sheet is really not QE. QE has a specific purpose, which is to take duration out of the market. That is not happening here. Effectively, bonds are still owned by the banks. The
Right.
Fed is simply financing it. On its balance sheet, the bonds and the duration risk is not coming back. So yes, they are doing a funding operation. It's very similar to what ECB did with TLTRO. But this cannot be classified as quantitative easing in any sense of the term.
Okay, so let me shift focus to the most watched event next week. What will the Fed do? Will they fight inflation or will they save the banking system?
Well, to some extent, they have already saved the banking system. So yes, there is financial strain, and that will probably continue for quite some time. But at the same time, I think the Fed is very interested in preserving its inflation-fighting credibility. Based on the employment report and the inflation report that have come out over the last few months, it's very hard to say that the Fed has slayed the inflation dragon. And I think to some extent, the ECB move yesterday of a 50 basis point tightening in the middle of all of this provides a kind of a pathway forward for the Fed as well. So My expectation is 50 basis points was never really on the table. If it was on the table, probably got done away with because of financial stability concerns. But 25 basis points is what they're going to do. And if they do not do that, that'll be a problem for the U.S. markets rather than them. And we may have a short-term rally for whatever reason, but I think the longer-term prospects for long bonds, it's going to be meaningfully higher than what it would be if they tightened 25 basis points.
Right. So if we look at history, this is perhaps the first time that the Fed is confronted with two serious problems. Just when it is coming to a close with its rate hike cycle, you have this crisis coming up. Now, to navigate both and stick to fighting inflation is going to be a tough call. And even if he unintentionally breathes some kind of dovish tone, the markets will swing the other way.
So I think it's a fair concern, and the Fed is very aware of that. So in a perverse way, the financial stability concerns basically do a little bit of the Fed's job. One could argue that they probably add up to 2 or 3 tightenings that they would have had to implement. And the reason for that is credit conditions in the U.S. are going to tighten meaningfully because community and regional banks are big providers of credit to a lot of small and medium-sized organizations. And because of that, those credit conditions tightening because of capital and balance sheet pressures, credit growth is going to slow down, and therefore the economy is going to slow down, and therefore inflation will probably come down faster than it would have without the financial stability issue. So I think the likelihood of a soft landing today without the Fed tightening massively from here, in my judgment, has probably gone up rather than gone down.
Right. So I'll ask you a very interesting question. So if you want to bet on Fed being hawkish or dovish, and therefore bet on which markets, which asset class, and how will you bet?
So I would say that the Fed is probably going to tighten by 25 basis points, and they probably will have a slightly hawkish tone, perhaps not the same tone that they had previously, but a hawkish tone nevertheless. In that environment, I think the near-term challenge for risky assets is probably going to remain relatively high. So I can't say this is the perfect environment for equities today. For 6 months from today, perhaps could be, but it's not there today because the risk of a recession and the implied drawdown in earnings and equity prices is still quite substantial. So my strategy has been to, we are a long-term investor. We try to focus on what is going to happen 5 years. So we haven't changed our allocation massively. Having said that, I think to the extent that we can make any move, we have tried to stick in cash rather than anything outside, at least in public markets.
So how much of cash are you sitting on?
Well, so, again, in our allocation, if our cash position was X%, it's probably 2X of that, but in a relatively small allocation. Because, again, as I said, we invest for the long terms. We are a large player in private markets, in private equity, and even in the public markets, because we have to generate certain returns over a long period of time.
Right. I cannot conclude this conversation without asking you this question about India. In all this madness, I would say, or the turbulence, where and how will India stand in terms of flows coming in? They were just about coming in and suddenly they are going back. So do you think we are going to face the wrong end of the stick on both sides?
Well, so it'll depend a great deal on how the U.S. economy and inflationary pressures globally pan out. My suspicion is that credit growth in the U.S. slows down and inflation comes down much faster than what we would have expected a month ago or 6 months ago. And therefore, risky assets 6 months out probably end up doing well, and India probably gets a more than fair share of the global emerging market flows. I think situation in China is not changing meaningfully at any time soon. And that bodes well for India flows, because people use that as substitutes effectively for large emerging markets. And I think those will resume in not too distant a future.
Okay, on that happy note, thank you so much, Krishna Memani, for joining us.
Thank you.